Okay guys, so in this video I will be talking about arbitrage on Polymarket. So I found this guy here, Rowan, on chain on Twitter. The math needed for trading Polymarket. He references a specific paper. Okay, so this paper here, Unraveling the Probabilistic Forest Arbitrage on Prediction Markets. So it's not specifically to Polymarket, however, they use data from Polymarket in this research paper. And I'm gonna make sure to leave a link to this PDF and to the tweet from Rowan on X down in the description. And this is very interesting because they actually look at several different arbitrage strategies on Polymarket, on prediction markets, and the conclusions in this is actually very interesting. This is a paper from August 2025, okay, so it's very recent, it's very new. So from the abstract, to ensure proper market resolution, the conditions set must be exhaustive, collectively accounting for all possible outcomes and mutually exclusive. Only one condition may resolve as true. Thus, the collective prices, probabilities of all related outcomes, whether in a condition or market, should be $1, represented by a combined probability of one of any outcome. So this is what we talked about before, right? On the crypto 15-minute market, if you can buy yes and no less than $1, then you are guaranteed a profit, right? Before the market fees was introduced. But on Polymarket, we have many different markets, right? So a lot of different opportunities. The questions that they are trying to answer here is, what conditions give rise to arbitrage? Does arbitrage actually occur on Polymarket, and has anyone exploited these opportunities? So what they are looking at single markets, and they are looking at multiple markets, okay? So for example, if we take Bitcoin up and down, this is a single market. It's one market with two different outcomes, but they are also looking at multiple markets, okay? So that is, for example, a market such as this one, Portugal presidential election margin of victory, second round, where we have all of these different, markets, different outcomes. And this is something we are going to talk about what that is and how to use it. So the specific arbitrage opportunities that they uncovered in this paper is, one is market rebalancing arbitrage, and another one is combinatorial arbitrage, okay? So for market rebalancing arbitrage, in prediction markets, the price of a yes token is interpreted as the market implied probability of that outcome occurring. For events with multiple mutually exclusive outcomes, each represented as a distinct condition, the sum of the yes token prices should, in theory, equal 1. When this condition is violated, that is, the total is less than 1, arbitrage opportunities arise. Traders can take long positions on all outcomes or short position if the sum exceeds 1, securing a risk-free profit when the market resolves. We refer to this as market rebalancing arbitrage, where we restore market consistency by adjusting positions or submitting orders until probabilities realign with logical constraints. So what do they actually mean about this? Let's take the example of this Portugal presidential election margin of victory, second round. We have all these different outcomes, okay? And you can see the probabilities. If you buy all of these, it should amount to $1, right? Because one of these will resolve to true. So in a completely efficient market, all these probabilities should resolve to $1. But if it doesn't, if it's less than $1, that's an arbitrage opportunity, because if you buy all these outcomes while the full probability is less than 100% or less than $1, you should, in theory, make a profit. Now you can see here, if I add all these together, the sum of all of them is 103.9 cents. So that means there is no arbitrage opportunity right now on this, because you would actually overpay with 3.9 cents or lose 3.9% if you were to buy all these outcomes on the yes, okay? But however, if let's say that it was 99, then there would actually be an arbitrage opportunity if you could buy all these outcomes at a total price at 99. You would in theory make 1% gain guaranteed. Of course, it also depends on if you have enough volume and the practicality of actually buying it, because if you have a very liquid market that moves and you were to see an opportunity where it was 99 cents and you were to execute your trades, but maybe some did not fill and it felt maybe a little bit more expensive, there's some risk there that we need to take into account. So there's opportunity there, arbitrage opportunity if we see the price less than $1 on the yes side. But what about the no side? You can see the no side here is 99.7, 99.2, 96, 84, and so on and so forth. Since there's only one of these that will resolve to yes, that means that all of them except for one will resolve to no. So if you can buy, or now there's 1, 2, 3, 4, 5, 6, 7 outcomes. If the combined price of all the no shares is less than 7 minus 1, meaning 6, there's also an arbitrage opportunity. Let's say you buy all of these 7 for $6, you would break even because you would be guaranteed that 6 of the 7 pays $1, $6. But if it was, let's say that all of these sum to 7 minus 1 minus your whatever edge you want, let's say 1%, so that could be 590 cents, you would have a small edge there. Now, when I sum all these together, all the no outcomes, we get a combined value of 601.6 cents. So again, no arbitrage opportunity. If you bought all of these no shares, you would lose 1.6%. But if it was 599, there would be 1% gain in theory, because there's no fees on these markets here, right? So if you could actually, if there was if you could get it to that price, 599 or 598, there would be an arbitrage opportunity there. So that's basically what they mean about the rebalancing arbitrage, and that's how a lot of the arbitrage trading bots work. Now, another one which is also kind of interesting is what they call combinatorial arbitrage. So here they look at two dependent markets as defined above. We can express the precise market conditions that allow for arbitrage and the resulting arbitrage strategy. A combinatorial arbitrage opportunity arises between two markets when it is possible to construct a portfolio of bets across conditions in both markets such that at least one bet is guaranteed to win. So what does it actually mean? So if we look at the table here, we have two different markets, M1 and M2, Democrat wins and Republican wins. And then we have Democrat margin, Republican margin. So these markets are dependent because if Democrat wins resolve to true, then Democrat margin will also resolve to true. That's at least the theory here, and this is kind of the play. And the same goes with this. If Republican wins, then this one, Republican margin, will also resolve to true. That means that you can actually have some kind of a cross-market arbitrage here. So if the combined value of, let's say, Democrat wins and Republican market is less than $1, you should in theory be able to place, bets on both sides and then get, winnings there, because let's say that Democrat wins is 0.45 and Republican margin is, let's say, 0.5. The total value here is 0.95, meaning that if you bought both at 0.95, you should be able to make 5 cents or 5% profit. That's at least their theory, and I think that is interesting. And how they are finding these dependent market is also interesting because they have some information about that later in the paper. So they do an analysis of actual on-chain data, and they use an LLM to do some kind of a semantic, search or reasoning between these dependent markets. And the prompt is actually in this paper that we can use for our own strategies. So they use in section 5, we employ an instance of the LLM DeepSeek together with market description data to capture the state space of possible market resolutions to then infer semantic dependency between pairs of market and their conditions. So they actually use an LLM to pass all the market data and find these dependent pairs and then do analysis of the arbitrage opportunities. And here they describe how they find these dependent markets, and it can potentially be very expensive with tokens, right? Because we can have a lot of data and trying to compare all the different markets. So they have one where they evaluate single market inference, and then they also have one where they do multiple market inference. And then they go into depth about how they actually do that with the LLM. You can read this by your own in the research paper. I'm not really gonna deep into that specifically, but this would be interesting. I think I might be working on this with Raven to actually maybe make a system where I use the LLM to find these dependent markets automatically when we have new markets coming in. So I could probably do something with basically do all current markets, do a vectorized database, and then maybe do semantic search on that vectorized database when we get new markets and something like that. I'm probably going to look into that in a future feature for Raven. And of course, if you don't know, I am building Raven in public. Raven will be this no-code strategy builder for prediction markets. So if you don't know how to code, or if you are struggling with making your own trading bot, you will actually be able to use Raven to create your own strategies. It's a no-code drag and drop builder. And I'm working on this in public, basically, and sometimes I live stream, and you can check out my videos and see how it works. So right now it's not public, but you can sign up for the waitlist, and the link is down in the description below if you want to get notified when it launches and if you want to be one of the early one to get access to Raven. So with that said, let's continue. So here they have this diagram of the event, will Assad remain president of Syria through 2024? And basically what they do is they plot here on the x-axis the date, and then they have the volume weighted average price of the yes and no conditions. Okay, so the fair price is here in the middle. So the fair price that they have derived is you can see here over in the right side, the sum of the two outcomes is 1. So the sum of those prices should be in an efficient market, I suppose, here in the middle. So, and then we have the average price here, the yes and no. So the yes is the green one here, and no is the orange here. And then you can see here the gray bar is yes plus no, which is very close to the red one. And you can see here, sometimes it actually deviates. It's probably hard for you to see, but what is interesting is there are conditions that they have set where they put their edge of 2%, and they've marked it with these X's here. So in high market volatility is basically where the opportunities arise. And then they also looked at actual opportunities taken, and I think they got this from the blockchain. So they mark their different opportunities and the opportunities taken. You can see here just for this one event how many arbitrage opportunities has actually arisen, where the total price for yes and no token is more or less than $1. And then they mention here, because we calculate token price from an average of executed bits, we underestimate the margin of profit arbitrage is able to realize. So they actually say that we didn't think we could make this much money doing arbitrage. We thought the opportunities was less than it actually is. And now they're actually looking into the opportunities. So within a single condition, so they begin by exploring arbitrage within a single condition, the yes and no position of a single outcome. So for these figure 6 arbitrage opportunities detected within a single condition, we show neck risk and single markets separately. Neck risk, if you don't know what that is basically an event that has multiple of these outcomes. So the total of this should be 1 on the yes, right? And you can read more of that on the Polymarket. So we have the Polymarket here. Negative risk, certain events which meets the criteria of being winner take all. Okay, so winner take all. So one of these is gonna take all, right? Winner take all. May be deployed as negative risk events markets. The gamma API includes a Boolean field on events neck risk, which indicates whether the event is negative risk. Negative risk allows for increased capital efficiency by relating all markets within events via a convert action. More explicitly, a no share in any market can be converted into one yes share in all other markets. Converts can be exercised via negative adapter. You can read more about negative risk here. So I would suggest you to read more about that, clicking this link in the Polymarket documentation. And then continuing on, we see that most conditions have only a few opportunities, with crypto having the biggest outliers. Most surprisingly, the median profit on the dollar for these opportunities is much higher than our 2 cents bound, and highlights large market inefficiency. And this is what we love to hear, market inefficiency, because that means arbitrage opportunity. And they had their edge, how much you want to profit, set at 2 cents or 2%, but they see that it's actually much higher. And here they look at the maximum single opportunity profit up to $100 bid per condition, and it's measured in the liquidity. We explore the total arbitrage possible if an arbitrager were to take advantage of the single most profitable opportunity in each condition at the maximum liquidity top and up to just $100 liquidity bottom. The latter shows us that the existence of arbitrage is quite split among markets, and many more opportunities exist in sports markets. Without capping profits, we see that the very lucrative opportunities are predominantly in politics, with higher profit per condition, most in neck risk markets. And here they say, overall, sports consistently has more profit, particularly in long opportunities, besides a couple of outliers in politics, suggesting sports markets are often overvalued. Here they look at arbitrage within markets. So next we consider arbitrage that is possible between the condition of a neck risk market. Of the 1,578 neck risk markets, 662 had at least one arbitrage opportunity. So almost half of the markets that they looked at had an arbitrage opportunity. In general, we see many more opportunities per market, averaging around 100 per market, with quite high outliers, particularly in sports. Okay, so what they did is, so first of all, they looked at like markets where there's one, yes or no outcome, and then they looked at the neck risk markets, that we just talked about, such as this, where you find opportunities buying, all the yes tokens for less than $1, or buying all the no tokens for less than, the amount of markets there is, -1, and then, minus whatever edge that you want to have, 2% or 3%. So arbitrage across markets. In lastly, this section, we look at possible arbitrage opportunities across 13 dependent pairs of markets during the 2024 US presidential election. For the pairs of markets, we again focus on arbitrage relating to the price of the yes token of all conditions. In figure 9, we show the distribution of profit per USDC and maximum profit for each opportunity given the liquidity at the time. The pairs are shown in order of number of opportunities. with pair 8 having none. So we can see pair 8 up here doesn't have any opportunities at all over here. And the median among the rest being 8 opportunities, pair 1, 2, and 4 have 72, 176, and 6,630 opportunities respectively, which is kind of crazy, right? So some of these pairs don't have any opportunities, while others have like an extreme amount of opportunities. We note that though we were able to observe arbitrage opportunities, they are largely doing lower liquidity moments and are at lower profits than the previous sections. The average max profit is around $100, suggesting total token volume in the market of less than 2,000. So here we can see the graphs of all the different, the 13 pairs that they observed. So this is profit per dollar distribution. And I'm not sure, I guess this is in, I'm not sure if this is in cents or what is this. But we can see there is some opportunities here, and then we have the max profit distribution in dollars. So that is for politics. And then if we scroll down, we see the figure 10, total profit made by all users in single condition markets. About 1% of our estimated US election opportunities were exploited by users. So only 1% of their estimated opportunities were actually exploited by users, meaning that there is like 99% more opportunities to be taken, right? So there are a lot of opportunities in arbitrage. And then they note here, interestingly, sports single market dominate in exploited opportunities, surpassing election profit. Okay, so sports betting is definitely where there's a lot of opportunity being exploited right now. And we can see here, figure 11 left, the total profit obtained through rebalancing arbitrage in neck risk markets. So that's what we talked about before, neck risk rebalancing. If you buy all the yes when it's less than $1, we see that most profit is found in markets relating to politics. Sports is surprisingly absent from this figure, likely due to a smaller scale of profits, right? The distribution of opportunities by potential yield per dollar. Most opportunities exhibit low returns, while a few outliers, primarily in crypto, politics, and Twitter markets, offer significantly higher yields. So we have this, that's in percent. So we have 0.05, which is 5% profit per dollar. So we have crypto is, most of them seems to be around what looks to be like, 1% maybe around 2%. And then there's some extreme outliers sometimes up here around the 5%, maybe around 3 or 4%. But like you don't even need much more than 1 or 2% to make a great profit if you can do it consistently again and again, right? And here they have on-chain data about the 10 most profitable accounts from their time frame. So table 1, top 10 accounts ranked by total amount and number of successful opportunities. So this seems to be successful opportunities that they actually did on chain, right? So we have number 1 doing $2 million, doing 4,000 transactions, and 2,000, 4,000, and 3,000. Some have not done that many, so maybe these 2 is manual, who knows? But these for sure is automated bots, because this has been from not a long time frame. Doing 4,000 manually is quite something. We see some very big players with bot-like behavior in the number of bits they participate in. The user with the highest profit generated a total of 2 million through these strategies. So this is very interesting, and this highlights a lot of the things we already talked about in this videos, but also some new ideas that we could work on. So just to elaborate, we have arbitrage on single markets where the sum of yes and no is less than $1. So if you buy both to less than $1, you are guaranteed a profit. If there is no fees, which we currently have them Bitcoin up and down, but we have other markets where we could do this. Then we also have the neck risk markets, such as this one, where the sum of all of these different outcomes should equal 1. So if it's less than 1, you can buy all of them and then be guaranteed a profit. And the same goes for no, because only because all of these, except for one, will resolve to no. So if you buy all of them where the price is less than, all the outcomes -1 and then minus your edge, you should be able to make a profit. So for example, we have 7 outcomes here, right? 1, 2, 3, 4, 5, 6, 7. If you can buy all of these for less than 7 minus 1, you should be able to make a profit. And then the last one that they talked about was the combinatorial arbitrage, which is a little bit more advanced, right? Where they take 2 completely different markets, right? Market 1 and market 2. And then they use an LLM to figure out if they are semantically relevant. For example, so the example they use here is Democrat wins. And if you buy this one, this Republican margin should resolve to no, right? So if you can buy this one here in market 1, Democrat wins, and buy this one here at no in market 2 for less than $1, similar to what we do here with Bitcoin up and down, well, then actually you should be able to make a profit. And in the paper, they did show that there's some people that actually did this, but it seemed like more of the opportunity and profit is actually on the neck risk. So on when we have all of these outcomes, this is where there was most opportunities, and they said there was a lot of opportunity in their sports and politics, and also a little bit on crypto and in some of the outliers. Yeah, I'll make sure to leave a link to this paper in the description. And again, sign up for the Raven waitlist. Again, I'm building this no-code trading bot builder. So if you want to build this strategy, you will actually be able to do this inside of Raven. And then remember, we also have the free community Poly Traders, which is again a free to join community for people betting on prediction markets, building strategies, building trading bots. And you can see here every day we have a lot of members. We are more than 1,000 members now in this Discord here. And we have a lot of good talk going on. We have different channels. For example, if you are building bots, you can go in here, talk about bot development. We have about strategy and data. We have predictions. We have about crypto, and we have about vibe coding. If you are building your own bot, you can get some inputs in here in this Discord channel. So with that said, see you on the next video. Have a good one. Bye-bye.